Jeff, as it comes to Coke, I understand you think the move here might be sell the stock into earnings or period. Is that right?
Yeah, I think you can even buy it a little bit lower. So I don't want to be a strong seller because you never want to fade Warren Buffett, the Oracle. The Oracle owns 400 million shares, Kelly. That's about 8% of the company. But if you look at this, it hasn't done much. And it's been a decade-long conversation or debate about Coke or Pepsi. And if you look at Pepsi, Pepsi has outperformed on a 1-year, 3-year, 5-year metric. So I want to own this potentially lower down at $50, but that's 10% lower. So if you don't have a position here, I would be a seller. I'd be taking profits just to see what they talk about the consumer, because that forward guidance, to your point, is going to be really important. It is trading at a discount to Pepsi, trading about 22 forward PE ratio versus Pepsi is up around 27. So there's value here, and Warren owns it, but I don't want to own it.
Do you think the declines in Pepsi and Coke are because of, if it's kind of the hype around weight loss drugs, that might be an easy entry point for long-term investors. But if it's because of high rates and, underlying concerns about consumer and the economy, that feels like a little more troubling story.
Yeah, and it may be. I don't think it's the Ozempic story. I think there's a myopic view here in the United States. You talk about Coca-Cola. They're in 200 different countries, so their products are well diversified. I just think it's overall consumer. And there's just other products out there. I see my teenage kids, they're buying Prime right now. They love Prime. We talk about it around all the time. We got Prime. We got Prime. That's the song they like to talk about. So they're moving a little bit away from the traditional Pepsi and Coca-Cola products.
We got Prime. All right, let's move away ourselves then and talk about General Motors. The UAW strike hitting both share price and production, with GM down an estimated 20,000 vehicles since the start of the strike. The stock is down 12% during that period. Deutsche Bank thinks we'll see some resilient demand, though, combined with reduced volumes. It could even prop up pricing. What are you thinking here, Jeff?
I'm an owner. It has been rough, to your point, Kelly. The last 3 months down over 22%. And they really have to thread the needle on this earnings call. When they're going to talk about the Q3 report, they can't oversell it, if you will, because that's going to hurt them and work against them in any type of negotiation. So this UAW situation is bigger than we think. It may be priced in, but I do want to be a buyer here. This is an essential name. You talk about GM, you talk about their EV ambitions. They're delivering on that. So I want to own it for longer term, but it may be a little bit volatile here as we get through this next week.
Do you think there's any, I don't want to quite put it this way, but that they'd sandbag the quarter so that they, appear weaker in union negotiations?
They can't do that. They have a fiduciary responsibility to shareholders. They won't. And I think, they're kind of chasing Ford year to date. Ford's outperformed. At the end of the day, they're going to be responsible in their reply, but at no means will they oversell the forward guidance due to those negotiations.
They are trading at 4 times earnings. 4. Yeah. I mean, is it going to go to 0?
It can't. GM is a name that I think you want to own. You talk about some of these blue chip names. That's an essential name. I actually own it in our Essential 40 portfolio. It's a boring name, but until they kind of get back to where they were, and you have to remember, this was trading at a 52-week high just at $43. So it's really come down at an opportunity, to your point, at 4 times. You have to buy it here, I think, and you have to hold it. But you have to be willing to get through this earnings call because it's going to be volatile, Kelly. You may see it go up and down 5% just predicated on that forward guidance or how negotiations may perceive their forward guidance.
All right, fair enough. And finally, we also are going to hear from Spotify in the morning. And those shares have had a nice year. They're up 90%, but they're well off those 2021 highs. They're hunting for profitability still, and the market doesn't like unprofitable companies in this environment. New AI personalization features, they're hoping those help reduce churn. They've added audiobooks to encourage premium subscription growth. What do you do here?
Look, I think you have to take profits here. I don't want to be a seller, but at the end of the day, up 95% year to date, you really have to be considerate where this has been halved. You go back 2 years, it was trading above $350. And I know it is the music streaming giant, but you talk about volatility in GM, whoa, we're going to have some volatility in Spotify. And I think when you really kind of peel back the onion, Kelly, investors and all the advisors I work with and support, they are going back and reverting to companies that make money. Spotify doesn't make money yet. So that question mark over the profitability and when is it going to come, that's going to hit some investors. And that may incite some profit taking, and you could see a little bit of a dip here in Spotify.
We also mentioned near-term options imply about an 11% move in either direction. Does that entice you as a trader or make you want to stay away?
As a trader, yes. I mean, you could consider it selling some put spreads, really defining your risk. But when I talk about Spotify owning it from a longer term investment, I don't get too excited, specifically if I've owned it for the last couple of years where, yes, we're up 95% year to date, but we're still down 50% on a 24-month view. So this is a highly volatile, nearly a 2 beta. So you have to understand what you own and what your exposure is if you're just trading this name versus owning it for the long term.